You're watching Asia First. Europe's trading chaos. Several European stock markets suffered a 5-minute flash crash, and Citigroup is reportedly the culprit. The sell-off was reportedly triggered by a large erroneous transaction made by the U.S. bank's London trading desk. Sweden's benchmark index was one of the hardest hit, falling by as much as 8% in just 5 minutes. The Dutch benchmark index fell 3%, while Belgium's declined more than 5%. It's not clear what caused the short-lived slump, but a spokesman for the Nasdaq Stockholm says it wasn't a technical glitch on its part. Some traders say it might have been caused by algorithm-based trades going haywire. Others say it was a fat finger mistake. Citi declined to comment. The Stockholm benchmark index ended the wild session down almost 2%, roughly in line with the drop in European markets. Citi closed down more than 2.5% on the London Stock Exchange. To the markets now, and Hong Kong is back from a holiday with declines of 2%, the biggest loser in a quiet trading session here in Asia Pacific. The Kospi managing to hang on to gains of about 0.2%, but Australia is still down ahead of the RBA meeting, where a rate hike is expected, and the NZX 50 is in the red. Let's bring in Terence Wong now. He is CEO of Azure Capital, joining us from Singapore. Thanks so much for your time there, Terence. Now, we've seen falls again for Hong Kong, despite that pledges of assurances from the Chinese government that it will try to help stimulate the Chinese economy amid the COVID lockdowns there. With these valuations, though, after these falls, do you think that Hong Kong equities could start to look attractive from here?
Well, I think if you look at Hong Kong equities, it's anyone's guess right now. But then they are very tagged to the global issues. There have been a confluence of negative factors that have been affecting the markets right now. There's geopolitical tensions, Fed's hawkish pivot, and that there's a slowdown in the global economy. So it is unsurprising to see that the likes of Hong Kong have gone down by 10% in the first 4 months of the year. Shanghai led the pack with 16%. I think looking ahead, Hong Kong being a high growth market, there are a lot of tech companies, and it is tagged to the growth of China. So we need to see a resurgence in China before we see a meaningful rebound over in Hong Kong. But what is surprising, though, is that the likes of Southeast Asia has outperformed that of North Asia, and it's the first time in a long time that has happened. And I think that is again because of a number of reasons. One of them is the valuation. We were still cheaper than I think the North Asian markets, and there is a rotation from growth where the likes of China, Taiwan, Hong Kong, they have a predominant number of stocks in their growth sectors to value sector. And surprisingly, Singapore is one of the outperformers. We have seen it go up by 10% in the first quarter. I think it's one of the best performing markets. Even up to the first 4 months of the year, it's been a challenging April, but STI is still up north of 7%.
Yes.
But looking ahead, I think it is cautious overall for global markets, as there's greater uncertainty with the global economy.
And with the Fed as well, Terence, I'll get to your insights for Southeast Asia in a bit, but just this week we are expecting more interest rate hikes in the U.S., and that could tighten financial conditions globally. Is that a big concern for you, and how much pressure will that put on Asian equities?
Well, I think if you look at the consumer numbers, the consumer growth price index, it has grown by quite a bit over in the US. We're talking about something that's really startling. That's 8.5%. That's the biggest increase in a generation. I think the last time you had to do that was like back in that we saw such numbers was back in 1981. Europe, no better at 7.5%. Singapore, we're already feeling the impact. I mean, from petrol pump prices to food, everything is going up. We are not exactly there, in the Eurozone and the US levels yet. But, we are rising and people are feeling the pinch. For the Fed, I think that they have been clearly behind the curve. When Joe Biden introduced that 1.9 trillion package in March last year, that they had an opportunity to actually tame down inflation or to actually sort of reverse course on their lower for longer interest rates, but they didn't. So, and at that point in time, the Fed chair, Jerome Powell, was saying that, inflation is just transitory, but you can see the narrative actually morphing over time. In November, he finally considered that inflation is an issue, and right now they're on war mode against inflation. Right. Yeah. So it may be, is it too little, too late? I'm not too sure about that. But history, I think, is definitely against the Fed. There are only 3 occasions where they have sort of restrained or actually tamed inflation without going into a recessionary environment.
So it is a challenge.
All 3 times, the inflation numbers are not so high.
Yeah, but I want to get your take on Singapore, Terence, because we did hear from the Singapore Prime Minister warning of a global recession ahead. How do you think Singapore will be impacted given the open nature of the economy?
Yes, exactly right. Singapore is small, it is open. So if there's going to be a recession, we will be hit. But like he said, like he considered, we have to just be very, very we just have to be very, very fluid. We have to look at the situation and we have to morph with times, with the situation right now. And I think that because of COVID, a lot of the major economies are closing up and we just have, and we can't afford that to happen. So, but we have to go with the flow. And I think that another issue that we have to grapple with is the US-China relations. We are friends to all. We are very good friends to both. But increasingly, it is becoming very, very difficult to do that because they are basically poles apart and they are moving even further away from each other right now.
Yeah, lots of challenges indeed, not just for Singapore, for the whole world really in the times that we live in. Thanks so much for your insights. Terence Wong, the CEO of Azure Capital. And that's your business.